Good afternoon, everybody, and welcome to the next fun deep dive live for Simplify. It's the Simplify downside interest rate hedge strategy, ticker symbol RFIX, RFIX. We like to also call it the Bond Bull ETF. It was launched on December 9th of last year. Couple housekeeping items really quickly. The chat is disabled. Please submit any questions in the Q&A section. We will answer them at the end. Also, this is always not meant to be investment advice, but entertainment purposes only. So without further ado, I will let you I will introduce, I should say, myself, Jason England, Managing Director and Portfolio Manager here at Simplify, and I have the pleasure joining me today on this fun deep dive live is Harley Bassman, Managing Partner and the brains and operations behind RFIX, the new strategy we launched in December, as I said. Welcome, Harley.
Hello, hello.
So I'm going to go over just a quick overview, and then we'll get into the weeds a little bit, or maybe not too deep into them with Harley, but I'll give you a quick overview of what RFIX is. Like I said, it's meant to be a bond bull ETF, more capital efficient way to access duration, either as a hedge or a portfolio management tool. It provides a simple and more efficient way to obtain significant duration. At issue is around 43 years. So it's going to be somewhere in that, 35 to 40 plus year range in duration. The key component here, though, is the 6 times the positive convexity of the 30-year U.S. Treasury rate. So that's where you really are getting a lot of the bang in this. It's a 7-year call option on the 10-year U.S. rate. And then finally, we're just a more efficient way to profit from falling, interest rates. Obviously, in today's market, we've seen some little bit of elevated rates due to, fiscal policies, uncertainty in the new administration, as well as sticky inflation and some strong data. So, it's probably near the top end of rates right now, but that doesn't mean you may not want to, start to position your portfolio for the next move in rates. Let's maybe this next slide, Harley, let's maybe dive into it a little bit more. Maybe you can explain a little bit more about the investment process and what we're doing inside the portfolio.
Sure. Hello, everyone. And I think they're supposed to ask questions in the chat or in the Q&A if they have questions.
The Q&A.
Okay, Q&A, not chat. Look, this product is very simple. It's kind of the reverse of our prior successful product, PIFIX. This product is I hate to say it, almost brain dead. You're giving us, a suitcase full of money. We put the money into T-bills, and then we use that money, a part of that money, to buy a 7-year call option on the 10-year. That's it. It's rather easy to model on Bloomberg or on your Excel spreadsheet. You probably won't do that, but that's all it is a 7-year call. Why this is amazing is that most options on the exchanges or anywhere else you're going to find them are 1 month, 3 months, 6 months. There's a few 1-year options available on certain products on the exchanges, but really you can't go past 6 months on most stuff. This is a 7-year option. The value of this is it just gives you so much time to be right and to use it. Also, it decays very, very slowly. I'm not going to go through the details of square root of time and this and that. I'll just say that this option, the theta, is a very slow bleed. As a matter of fact, it is so low that the RFIX product as modeled initially actually carried a 2% positive yield. Imagine that, buying an option having a positive yield of 2%. We'll talk a little later about why that is, but mostly it's because of the 7-year. It's very positively convex. What does that mean? Remember, convexity is a measure of the difference between the up and the down. So if I can go and place a simple coin flip bet If it goes heads, I make 50 cents, I make $1, I lose $1. That's zero convexity. It's a linear payoff. If I make 2 and lose 1, positive convexity, lose 3, make 2, negative convexity. And trying to figure out how to price that, risk return profile is how you price an option. And because we're using an option in this thing, and only an option, it has massive convexity. It goes up much more than it goes down. Jason, you want to go flip to that slide? I think number 3 or 4 has the up-down profile.
Sure. Here we go.
Let's look at this. We brought this thing a month and change ago. It was priced at 60. And I'm comparing this to investing $30 in what was at the time the 30-year treasury, and then $60 into a 30-year zero coupon bond. And what you can see is I show the instantaneous shift. Now, a little cheating going on here. I'm assuming it's a parallel shift at every rate. The 2-year rate, the 5-year rate, the 30-year rate all move the same. I'm assuming that the implied volatility doesn't move, which is a base case assumption. And you can see, look at the down 200. So rates go from 4.5 to 2.5, which is where we were only a couple of years ago. RFIX, the bond bull, makes 153% return. The other way, rates go up 200, so you go to 6.5% in the 10-year, you only lose 45. That is a measure of convexity. You're making massively more than you're losing. Now, you have the same thing, positive convexity in the treasury and the zero, just not as much. So your 30-year treasury goes up by 42 and change 42.9 and goes down by 26.8. And then the zero, the zero coupon bond tends to be the preferred way for people to go. We get a lot of duration and a lot of convexity. And you can see here, up 80, down 44. So it's much more than the 30-year, but RFIX just blows them away. RFIX is basically, the 151 rum of duration. And that's the magic here, is that you could invest in this thing, have a positive return, and have an incredible up-down profile. It just beats everything else out there. And it's very liquid. Most importantly, it's on an exchange. The magic, and this is the magic of Simplify in general as a firm, is we have the ability to trade professional products with Wall Street dealers. We're on even footing with State of California, PIMCO, Prudential Life. We can trade all the stuff that they can trade, equal footing. A 7-year option is a rather standard product on Wall Street for professionals. It is not available to civilians. At Simplify, we bring professional products to civilians in a listed ETF transparent format. And that's what we've done over here, simply is take the 7-year option and make it available to you. What you could do with that is now rather magical. Any questions so far on this?
I haven't seen any so far, none. Yes.
Okay. Let's go on, Jason. What's next?
So then we go into kind of the portfolio applications, and I guess where you see, and I guess that leads into the capital efficiency that we saw on that last slide, not just the positive convexity, but the duration component that you went over in there, and why this is so much more capital efficient and kind of the portfolio use cases.
So let's think of this. Why would you buy this product? Number one, truth be told, I think it's number 2 or 3, but number 1, put it up here, is you want to go and just make a straight up bet. You think rates are going down, they're going down sometime soon, and you want to go and make the most money possible via an exchange traded product. It's not like futures contracts. This is it. It's the most levered way to get duration and profit if rates go down, bond prices go up. As a speculative tool, fine. Go ahead and do that. I don't care. The better idea is use in an ordinary, managed, thoughtful portfolio. So ordinarily, people are very comfortable with this whole idea of the 60-40. That tends to be the benchmark that everyone uses. So ordinarily, you might go and buy, $40 of your portfolio, buying either the aggregate bond index, or buying treasuries, or buying the 20-year security, something of that nature. What RFIX does, it allows you to access the same amount of rate sensitivity with fewer dollars. And therefore, these conserved dollars can be used in other manners to go and access risk profile. With the duration of 40 and change, you only need to buy $20 of RFIX to get the same profile, same exposure to interest rates as buying the bond ag, which is a duration of about 6.5, 7. That leaves you $80 to do something else. Invest in real estate, private equity, private loans, or the stock market. It's a way to go and access the core idea of a bond. Now, when you own bonds, you tend to own them for two reasons. One, diversification from equities, and the idea being that you're going to go and historically the last 20 years, that bond prices go up and stock prices go down and vice versa. So it's a way of lowering the overall risk of your portfolio, a portfolio balancing tool. That's one idea. The other is I just want pure income, to feed myself. And when you become older, you tend to want to value income over total return. This product allows you to be very efficient in both of those because you can go and access that duration, that hedging component, the offsetting the stock component with fewer dollars. And you can take those other dollars and buy higher yielding assets. And that's the capital efficiency concept. So Jason, I think next slide.
Yeah, so this would tell you that the kind of synthetic portfolios that you can create. So maybe walk through those kind of using RFIX to mirror, like I said, like you were talking about the duration and the yield of the aggregate bond index, but using RFIX is a piece with some other type of portfolio in there to continue to get you some yield.
So we're showing two of our products that have higher yields and some short convexity to them. But you can use any other listed product or unlisted product to go obtain this. But these are good examples because they're on the exchange and they're transparent and easy to look at. So let's look at our CDX product. It's a high yield product. It's better than most other high yield, but I'm not going to sell that product now. Let's just call this thing your basic, high yield access listed ETF. So a yield of 8%. What you do is, in this example here, you buy $93 of this 8% security, $7 of RFIX, and basically you increase the yield of your portfolio from 5.1, which is the current yield of the aggregate. And what's the ag? The ag is basically, it's your standard measure. It's every bond on the planet dumped into one bucket, okay? There's plenty of ETFs out there that buy the ag. It's the easiest way to go, I suppose, is just get exposure to the bond market with various caveats. In this case here, what have I done? I've used two packages together. I've upped my yield by 2.5%, and I have about the same duration, the same hedge value, the same bond prices go up when stock prices go down. So it's kind of a capital efficiency. It's kind of a more efficient, clever way to go create a similar risk profile of yield and duration. Below that, our MTBA. MTBA is what I view to be a superior way to get exposure to the mortgage market because it buys the newer high coupon mortgage bonds, whereas the mortgage index and its associated ETFs, they buy the index. And the index is basically like, 3.5% mortgages that were created 4 years ago, which have longer durations and lower yields. The problem, of course, when you buy these higher coupon bonds is they have a higher yield but a lower duration because they can prepay quicker. To offset that, you buy in some of the RFIX here, gives you a higher yield in the bond ag, and then matches the duration. And the beauty is really this, is that when you're long a mortgage security, you're short an option. You're short the prepayment option. A mortgage bond kind of looks like a buy right, where you buy a 10-year treasury and sell a 3-year call against it. RFIX, you're buying back almost the same option, but it expires in 7 years, not 3 years. So it pairs up very well. Those two risks are kind of very related. And by creating this package, you get a higher yield, similar kind of duration. So once again, capital efficiency, a way to go and improve your overall yield and maintain the hedge value of your portfolio.
And we don't have it listed here, but I mean, I guess another way, some people, when they look at MTBA, because, it has the higher coupon, so the higher yield to maturity, but less duration because of the embedded option of the prepayment risk in some of those higher coupons. Could you pair RFIX with MTBA to, basically mirror the mortgage index as well, right?
Yep, you can do a lot of things with this puppy. Just because it's just so concentrated, you don't need that much of it. It's many fewer dollars. You can also, it's not here, but if you compare this to buying like a 20-year treasury, a longer term treasury, which is a popular idea, this will create generally a better profile because of the convexity, because it makes so much more that loses on the way down. Matter of fact, Jason, I think we have another slide here. Go forward a little bit. One more, right here. Now here is RFIX. No, back. This is RFIX versus a the long day, the zero coupon bond, the one that we spoke about in the beginning as my comparison. Basically, RFIX has tracked this thing all the way down, right? It's done kind of like we thought it would do. Actually, it's done better than we thought it would do because it's basically gone 1 for 1. But on the upside, this thing will utterly destroy it in a rally. And so we're kind of showing that we said that RFIX and long zeros would kind of be the same on the way down. And for the last, I guess, 7 weeks, it's done that. So it's kind of like the proof of the pudding idea.
And that the upside obviously is that convexity component. So what's the outlook or the average convexity is going to be somewhere in the 6% range. Is that what you'd say for this
It depends how you measure convexity, but basically the convexity of RFIX like 3 to 4 times more than the zero and 6 times more than the 30-year treasury. There really is. I would not say there are ways that people talk about convexity, but they're a little tricky. I tend to look at it as up versus down. What's the difference? Other people talk about it and changes in duration and things like that. I tend to like them where the rubber meets the road. How much do I make? How much do I lose? As a measure of convexity. As I said in the very beginning, make a dollar, lose a dollar for an even bet. And we saw from the very first slide that RFIX makes a lot more than it loses in equal up and down moves. Let me, is there any questions yet? Okay.
No, I don't see any in the chat.
Let me dig into 3 or 4 things here. Those of you who are professionals, this is easy to replicate on Bloomberg on the SWPM screen. Easy to do. Most of you guys probably would have that, so it doesn't matter. There are 2 or 3 risks to this thing I want to go open kimono about. We're not going to have a parallel shift. We will not have, the Fed funds rate and the 30-year bond go up and down by 200. The curve's going to move. So there is some curve risk to this trade over here. And it's not a lot, but it is some. The bigger risk is going to be implied volatility, which is going to move with the market. Once again, I've left it fixed in my example, but that's also tends to be, another thing to consider. It's a feature, not a bug. Because if you're buying RFIX to add the duration component to your portfolio, and you're adding the duration component because you want the hedge value of stocks go down, bonds go up, all hell breaks loose, you want that vega, that volatile exposure, because if all hell breaks loose, stocks down, bonds up, you're going to see implied vols rise. And this product will get an extra boost from higher volatility. Now, similarly, if the market doesn't move, we'll probably see vols come down. So the product will bleed a little more. Right now, we've modeled this product. It looks like it coughs up a 2% positive yield. So tax and tip, the whole thing, You buy it today, $100 today, it should be worth $102 in a year. That's a theoretical construct. I wouldn't say you can rely upon it, but I mean, you got to start somewhere with a profile, and that's what it looks like. And this is definitely very different than what you get when you buy an ordinary option, which basically decays quickly and goes to zero. Why does this happen? There's two reasons why. One has to do with interest rates. I'm going to ignore that. The other that's vastly more important is that in the long dated, and I mean really long dated, like going out 10 years, not like 3 months to 6 months, the big long dated interest rate profile, when you look at the S&P, 1 month, 3 months, 6 month, 1 year, 5 year, those vols go straight up. 5 years more than the 3 year, 10 years more than the 5 year, because you have more uncertainty out in the future. And people are unwilling to go and sell a 10-year option because remember, when you sell an option, limited loss, unlimited gain. Kind of suspect to sell a 10-year option when you think about it, when you have limited gain and unlimited loss. So there's not much supply of those. That's why the vol goes up. Foreign exchange, same thing. Volatility tends to go up uniformly all the way out. In interest rates, you see volatility go up to about the 2-3 year point and then come down to the 10-year point. You could look up Formosa bond. Formosa as in the old word for Taiwan. Go Wikipedia that. That'll explain what these bonds are. It is the issuance of these bonds that creates supply of these 5-year, 7-year, 10-year options in interest rates to the market. A lot of them. And that pushes down. And so basically, a 10-year option is a lower implied volatility than a 7-year option. And a 7-year option is a lower implied volatility than a 5-year option. So what's happening here is as we go, this embedded option, that's all this trades. Remember, it's $1,000 of option per share, and that's it. As time goes by, and you go from, let's say, a 7-year option in 2 years to a 5-year option, there will be a bleed of theta. As time goes down, option prices go down because there's less time there. That's obvious. But with interest rate options, that implied vol goes up. And it goes up by enough to offset much of the theta. It's kind of magical. It's kind of crazy. I'm a 40-year Wall Street guy. I traded in these products forever. And this is why, we brought these products to Simplify and to you, is because it's a kind of insane idea that's only available to professionals, but now they're available to civilians. And that's the magic. Could this go away? I suppose it could, but it's not tomorrow. And this what creates this interesting value is tax and accounting rules in Taiwan, like the butterfly effect, puts a tidal wave here in the US where you can buy very, very inexpensive options on interest rates. And that's the magic. There's no hand waving going on here. It's a situation of accounting and tax in Taiwan that drives a value proposition in the US.
Got to maybe let you get a drink of water here, and we got quite a few questions come in now. So let me start going through those. So ideal use case seems like a tactical tool and not a long-term hedge. Example, PFIX. RFIX upside is capped by rate floor. PFIX upside is unbounded in theory.
That's actually not true. If you take rates up high enough, PFIX will go to zero because you start discounting cash flows at 1,000%. Today it's worth nothing. So rates aren't going to 1,000%, by the way, but theoretically PFIX would actually roll over. I actually disagree with this. I think that PFIX tends to be used more tactically, whereas RFIX is a vastly better long-term portfolio tool. Because what's going to happen is this: it's a 7-year option today. 2 years from now, at a 5-year point, I'm going to roll this option back out to a 7-year for a bunch of reasons. But other than that, I'm not touching it. But what you can do with this product is get that rate exposure and combine with something else. I was talking to a client today. They're investing in multifamily housing. That's a 3 to 5 year project to go shovel in the ground, build the puppy, get long-term financing, and sell it. Cash on cash yield might be 6. Total return after the whole thing is done might be 9 to 12. That thing is going to have a yield to it, but it gives you, there's no mark to market, there's no hedge value, there's no way to offset your portfolio with the balancing of the 60-40. Once again, the notion that duration is a hedge for a bad news in stock market, the balancing risk reduction idea of 60-40. And you go and put 20 bucks into RFIX, 80 bucks into that multifamily project, you have a much higher yield, and your core portfolio is still 60-40 on a duration basis. So I would push back on the notion that RFIX is tactical. You can use it tactically, but as I said in the beginning, that is not my primary use case. If you want to go speculate, be my guest, but I view this product as a way to go access duration and stabilize your portfolio over the long horizon.
Okay. All right. We got another question. Could you compare RFIX and specifically its convexity compared to a 3 times daily levered long treasury fund without specifying the actual ticker? I think we get where that's going at. We might have had a slide with that, but we didn't present.
Well, yeah, you're right. I can't say tickers, man. Well, as a matter of fact, I've already done that exact task. If you model it up, even up, instantaneous move, it's pretty close. It's pretty close. But here's the problem. I'm giving you direct drive total return forever. Whereas those triple daily rebalances, there's what's called a volatility drag on them. And what that means is, let's say I have something that goes, I buy it, and on day 1, it goes down by 10%. On day 2, it has to go up by 11, right? Because I go from 100 to 90. I have to go up 11% to get back to 100 again. Well, if you keep bouncing around up and down like this, you burn money away. And if you actually look at the 5,000-page prospectus of all these daily rebalance products, they will say somewhere on the first or second page, this is not a long-term product. This is a short-term speculative, asset, because the vol drag will eventually just burn this thing out. So this is very different than that. Now, if I suppose if you bought futures contracts, basically like 3x the US or 5x the TY, maybe probably more than that actually. In futures, I suppose that could replicate it. But the problem you have there is you'd be rolling your futures every 3 months, and you create a capital gain that'd be taxable, you have to spend money, and you'd be burning away your principal on this thing as you pay taxes each time you did a dollar roll, a quarterly roll. So that doesn't work either. I mean, it works for a month, but I mean, if you think rates are going to go down tomorrow, then just buy buy futures contracts levered 5 to 1, 10 to 1. That's not, I doubt you're on this call if you're doing that. So this is much better than all the other products out there. And the convexity is much greater because remember, I hate doing bond math here, but 3 times the 20-year is not the same convexity as RFIX. Okay, it's your classic barbell analysis. Convexity is much greater when you go out further. So just levering something up does not give you the same convexity of a similar duration asset. Okay.
All right. Good answer. Next question. Does RFIX respond similarly as PFIX to Vega?
Yes. I got to do the bond math on this thing, but they're in the same zip code. They're both, I think PFIX now is like a 5.5-year option. I'm gonna have to roll it again soon, I suppose, but it's on a 20-year rate. So 5.5 years of Vega, but on a 20-year rate with a bigger DV01 is probably similar to a 7-year option on a 10-year rate. So I'm going to say that plus or minus they're pretty close. As a matter of fact, one of our quants here brought an idea to me, which I kind of poo-pooed, but that's why he's smart and I'm not. He said that a combination of RFIX and PFIX modeled up actually gives like a kind of positive return over time that looks very compelling. I got to play with it more before I put my stamp on it, but the first cut is it looks very interesting. The reason why is RFIX and I'm going to guess PFIX also both have positive returns. So your base case is probably 2 and change percent, which means I'm getting the convexity for free. And then if I get a big market move, well, then I'm a winner either way. So the combination of RFIX and PFIX, it's an interesting profile. I like the idea in concept. I need to do more work on it before I actually put it out there and say this is a great idea. But I can tell you this, it's certainly a good idea if you're uncertain. And looking into the current political calendar, what do we know? We know take him seriously, but not literally, I think. But we don't know. We just don't know. And is he going to go and really deport 8 million people? Kind of doubt that. He's going to deport 1.5 million. Maybe. What does that mean? Well, let's remember, what is GDP? Okay? Taking the politics away. GDP is people times hours worked times productivity. That's it. People, hours, productivity. You go clip off 1.5 million people, that's actually a real number. And will that have an impact? Well, we have less GDP. We also have less demand, less supply. I mean, it's unclear what the actual result is. In my last commentary, I wrote about the Peterson Institute did which is, I think they're nonpartisan, did an analysis of the various impacts of deporting 1.5 million people or 8 million people, putting on tariffs in China of 60% versus 10%. You guys can do all the research and figure this thing out, but what I can guarantee you is this: we don't know. We just don't know. Mike Green, my partner and friend, he thinks we're already in a recession, and maybe we already are. I think the other way around. I kind of think that growth is just fine and that inflation ain't going away and higher for longer. But once again, I might be wrong too. I don't know. And if you can go buy a positive carry, which means interest higher than zero, positive carry asset that has massive convexity to it either way, you gotta kind of like that.
Yeah, somebody actually asked that question. So you answered it before it was asked as far as pairing them together. I guess the follow-up the person had was the weightings, and I think that the initial runs that our quant team here has done is the 50-50 weighting, but I guess depends on your view on rates or where you're afraid you're going to be wrong on your call. So I mean, I don't know if would you suggest weightings, Harley, or just go with the 50-50?
50-50 is fine. Like, why think too hard? Don't reinvent the wheel. I do want to circle back to now that we're getting a little deeper into the story here. We ran on the profile there enough RFIX to give you a matching duration to the ag. So we say here's ETF X, and we're going to do some percent of RFIX to give you that 6.1 duration. I would weight this higher. We're trying to give you a profile that just demonstrates the idea of capital efficiency. With rubber meets the road, that's not enough, especially for the credit. I would be doing at least 10%, maybe more, in the CDX plus RFIX. And the reason why is that when you're long junk bonds, high yield credit, you are effectively short a credit option. And that credit option is going to have a stock bond component to it. Bad things happen to good markets. You're going to see credit spreads widen. What that means is the duration, the effective duration will shorten. As a matter of fact, the duration could even go negative because as we've seen, sometimes you have bond prices going up, stocks going down, and junk bonds going down also because they're widening. They're widening faster than the rate is going down to offset. So if rates go down by 50, but spreads widen by 100, that bond will go down by 50 bips of its duration. That's why I would want to go. If I do this credit trade here, I'd be bumping that duration up to easily 7.5, maybe 8. The coupon you're getting from the CDX will cover all your problems. in a down trade, and in an up trade, you'll need that duration to go and offset it, because we're kind of working on the correlation of credit duration versus rate duration, and they're related, but it's squishy. So I would overcompensate and run that thing to a 7.5 to an 8 duration as a package. Now, MTBA, that one not as much, because the embedded option you're short in a mortgage bond is a rate option, not a credit option, right? We're buying Fannie and Freddie bonds. They are not going to default, even if Ackman gets his way. They're not defaulting. So therefore, I'm pairing short rate vol, MTBA, or any other mortgage product, long rate vol, RFIX. And that they offset each other. That correlation is pretty tight. So I'm okay with running this thing this way. I would run it a little longer. I do probably 7-8% on this thing. It's get a little longer. Just because I have the convexity in my pocket that way. I mean, big positive convexity will offset a lot of mistakes. And when you have the convexity that you have in RFIX, you could be wrong and still be really right. What's happened on the other slide, Jason, go back to that one where you showed RFIX versus the zero.
Oh, okay.
Wait. Go back up again.
Go back up. All right.
Yeah,
Right there.
one more, right here. Now look at this. You see in the up 50 case, we're supposed to be down 13.6 on the zero and down 18 and change on the bond bull. So we should go down by 5 points more in the bond bull than the zero. And we've backed up basically 50 basis points from when we issued this thing. Okay, now cycle down to that Bloomberg chart. Yeah, we really have not. This thing is basically one for one. And what's happened is this, because of the, I won't say violence, but the quick nature of the move up in rate, down in price, implied vols went up. So the Vega, increase in Vega offset most of those 5 percentage points of loss. That's what happened here. And so that's what I'm saying. But when you have this embedded optionality, this Vega, this convexity, it covers up a lot of mistakes. When you're in a situation where you could make much more than you could lose, talking really kind of offsides bets here, it covers up mistakes. And I will tell you, every market crash, world explosion, there is short convexity lurking at the scene of the crime. 87 crash, 94 crash, the 08 GFC, it's all massive embedded short convexity, short optionality in the market that all of a sudden can't be managed by people. It's always short convexity at the scene of the crime. And that's why buying RFIX or PFIX for that matter, but RFIX over here, really, that's a terrific idea because everything's going your way. When things get hairy, the vols go up, and this thing has some real kick. You have a 3-month option, you buy on something, vol goes up by 20%, the price doesn't even move, man. You see the vols go up on this thing by a little bit, it's going to move. So that's why you like this thing.
Yeah, I mean, I guess that really, this shows the convexity, and I think that's what some investors right now that I'm hearing talking about RFIX is, maybe they are bearish on rates right now, but they're worried maybe they're wrong. And so with that convexity component, that hedging component you have in a product like this, it's going to kick in, like you said. And back to back to around the high yield weighting. Another reason probably to weight to weight it more and when you're pairing it with high yield is looking at where high yield spreads are right now. You're historically tight levels, so you do want that extra duration hedge in there that's going to overcome any any swift moves in spreads on high yield spreads right now being so tight. Okay, we have a few more questions. The next one is best guess, does vol trend up or down over a 7-year period?
Rate vol?
I assume that, well, doesn't say, but let's
sure
assume rate vol.
I'm sure you're asking me about the move and the VIX.
Yeah.
The VIX is too low. Traditionally, I'm talking 1 month options. Traditionally for very liquid instruments, FX, bonds, stocks, some commodities, the big commodities like a gold, you will see a 1 month implied volatility on the option trade 8 to 12% over realized. This is why you see so many strategies out there of selling 1 month vol every day, then delta hedging it every day at 4 o'clock to reap that insurance, premium of 8 to 12%. Now, clearly, what happens when you're an insurance company, you make money, and then of course you have a fire and you're sad. But if you've sized it, your book right, you'll make money over time because you've priced it so you can do it right. What happens, of course, is people tend to oversize these things and not really think about the longer term nature of it. But in general, you see implied vols trade 8 to 12% over. The reason why is multifold. One of them is the market's gap; they're not continuous. Another is that people are not risk neutral; they're risk averse. And also the distributions aren't normal; they have fatter tails. But nonetheless, that's what they are. Right now, the VIX is at 15-ish. And remember, the VIX is not the at the money option. The VIX is all the options, the full tail. So the actual at the money option is 2 points lower now at about 13, and realized vol for the last month's at 18. That's the wrong way, man. I mean, vol should be above realized vol. So that vol's the wrong price. The move, is the other hand, which is trading around about in the mid 90s, realized vol on the underlying components of the move is right about 75 to 80. So once again, there you have it. You have your realized vol called 78, and implied vol 95. There's your 15-point premium. That's the right price. I do think you're going to see. Well, this chart, you got to go to my website and look at the move for 40 years. It's probably going to come down from 95 after we figure things out. So I kind of think that bond vol is going to come down a little bit, and FX vol is stock vol is going up a little bit from here. But that may not have been the question you were asking. You may have been asking, what's the vol going to be on my 7-year? Now, that's a different story entirely. What has happened is that the issuance of Formosa bonds out of Taiwan has been reduced over the last couple of years. There's still this massive supply of a decade of these bonds coming on down. But in the last 2 years, supply has been reduced for a variety of reasons. And as this supply is reduced, the spread between the 3-year option up here and the 10-year extra option down here is going to compress, it's going to come in. It's not going to go like this, but it is going to come in. So you're not going to see, I don't think you're going to see a huge decline in vol on these 7-year longer dated options. I think they're going to be supported because of the lack of supply from Taiwan. So that's a kind of a mixed question. Basically, what I'm saying is you're going to see a term surface rotation of these 1 and 3 month options in bonds coming down, and the 10-year vols kind of going up a little bit. That's kind of what's going to happen. And equities, I have no idea.
All right, we got another question. Theoretically, due to holding $30 worth of T-bills, is $30 the worst case scenario for the downside?
No. Yeah, I guess it is. I mean, I'm trying to think of what that actually means. Because we keep buying new options. But yeah, I suppose under the current construction, this thing would have a very hard time going below $30. Yeah, right now, we'd be floored out. I'm trying to think way in advance, like if prices go down and we're here, and then I roll the options out, I have to go and spend new money to go from a 5-year to a 7-year. There would require me to spend some dollars. And though theoretically, so maybe I've spent $5 more, so now my floor is 25. But also we have a product trading at 40, so dollar for dollar. I mean, the answer is yes. It's floored at 30. I'll leave it at that. But you can see how my pea brain's ticking over here about the path dependency of how we do this thing.
Okay. I think you might have answered this earlier, but just maybe, walk through it a little bit more. So I know it's an active managed fund, but you don't like to call it that active. Like, how often are you going to look to reset the swaption? How does the mechanism work? Obviously, you got inflows and outflows to manage around, but just in the decay of the option, maybe go through that a little bit about resetting it when.
This is legally an active fund. I'm not sure what the reasons are, but my bosses have told me it's an active fund. This thing is not an active fund, okay? I got one date, I got a strike, and that's kind of it. What would happen is this. Let's just say the rates are still in this ballpark of, I don't know, 3.5, 375 to 4.5, 475, somewhere in that zip code there. Come 2 years from now, so it's now a 5-year option, I will be looking to roll the option back out again. I did not pick the 7-year expiry by throwing a dart. I mean, theoretically, I could have bought a 10-year option, which would be even cheaper because the vol's lower, right? But there's reasons why you don't want to do that, which is above the level of this conversation here. The 7-year hit the sweet spot. At the 5-year point, I'm going to start to slowly get to a level where the decay starts to be greater than the income I get from the cash. And this product will start to be a negative carry product. And I kind of think when it becomes a negative carry product, that people are going to like it. And also, because convexity is a function of time, believe it or not, the convexity will get greater, all else equal, as time goes down. I mean, remember, a 1-day option has infinite convexity. If your strike price is 100 and at 3:58 in the afternoon, we're trading at 99.99, the option's worth zero. If we're trading at 100.01, it's worth, well, something. I mean, at that point, you have infinite convexity going from 0 to 1. So that's kind of the concept of why as time goes by, it becomes more convex. It's already a pretty convex monster. As this thing started rolling into like a 4-year or 3-year, it's almost you can't handle the truth. It's just too much convexity for you or for anyone to manage. And so for both those reasons, it's just too much gas, and I start to lose. It starts to decay faster than I like. I'll push it back out. So that's reason number one. So call me in 2 years when I roll this thing. The other is if rates were to go down a lot. So we're at 4.5 right now. If rates went to 3, I would probably have to roll this thing, roll the strikes. And the reason why is this: we have a SEC limitation. Remember, this firm came into existence from an SEC rule change that allowed us to put derivatives into ETFs. That's why I came out of retirement, to go and do that. I'm a derivatives trader. Came out of retirement to put derivatives into ETFs. But they gave us limitations, so we can't blow the place up. And these limitations have to do with VAR, value at risk. And there's calculations that are done, and we have risk guys who go and run the squirrels run in the little chamber there and figure it out. Once we get rates low enough and the price high enough, I start to hit these VAR limits, and I got to go and do transactions. This happened to PIFIX. PIFIX, if you recall, 2 years ago was the #1 product on Wall Street for whatever. It was up like some gigantic percent. It went from 37 to 114. And I had to go and roll all those options, before we hit limits, which create other problems for me, having with a giant lot of $40, distribution, which I didn't want to do. Similarly over here, but I'll get around the distribution this time. If I get this thing up to a dollar price of 120, I'm going to guess I'm going to have a VAR limit, have to roll that option, where I'll take the strike from where it is now to down 50 bips, something to lighten it up. I'm not going to take it all away, but I will lighten it up. So that'll happen. Those are the reasons why. It will have zero to do with my market opinion. I have a market opinion. I know what it is. I'm happy to tell you what it is. It has nothing to do with how I trade any of the products that I'm involved in. My products are opinion neutral. They are ways of giving you a vanilla access to pure something, whether it's mortgage or duration or convexity. It's just a pure form with no bells and whistles added. It's up to you to decide how to go and mix it with something else. Theoretically, I could create these fun portfolios where I mix MTBA with RFIX. You know what? That's your job, not mine. I have ideas, but once I start mixing it in, do I have the right number? No, there's no right number. There's better numbers. There's no right number. And I'll leave that to you to figure out.
A final question then, as we're running up on time here. So what, we talked a little bit about, resetting when there's decay in that or rate moves, and what does that do for duration then? So if you see some of those shifts that we were talking about where you get, plus 200 one way or minus 200, how does duration move around in the portfolio? We've seen it obviously because we issued at a 43-year duration and the rates have backed up 50 basis points or whatever. I guess I just want to set expectations for the clients on that this could move around because as you like to call it, it's supercharged or bond bull ETF.
151 rum of duration. I like that.
There you go. 151 rum of duration. Yeah.
So we had a client call up a few days ago because we posted the duration on our website, I believe. And we posted a 36 duration, and he goes, "What the hell, man? I mean, it said 43 on your commentary." Like, that is the definition of positive convexity. It goes in your way. At issue, 50 basis points ago, you make $43 kind of up and down. Now you make her lose 36. You're losing as rates go up. You progressively lose less for each basis point higher. That's good. You're losing less as rates go against you. When rates go down, bond prices go up, duration goes up from 43 to 45 to 50 to 60. It's going your way. Positive convexity means it's going the way you win. And convexity means it's going against you. Positive convexity, it's a goodie. You got to pay for it. You buy the option. You give someone a suitcase full of cash. Negative convexity goes against you all the time. But you're getting the suitcase full of cash. It's got to think of it in those terms. We fully expect the duration to go down as rates go up and bond prices go down. If it didn't, it wouldn't be positively convex, would it? So feature, not a bug. It's the definition of convexity. It's a fair question to ask. Everyone hates convexity as an X word. It's only one X word people like, and we don't have that in this product yet.
All right. We don't have any more questions in the Q&A. Is there any final comments you want to make, Carly, or we can wrap it up here? We're coming up close to the hour.
I would say one thing about circling back to someone who talked about using RFIX as a hedge product as opposed to a capital efficiency or a portfolio construction product. Do you want a car? Yep. Do you have insurance? Of course you do. Do you expect to crash your car? No. So then why are you buying insurance? You don't expect to crash your car. Why are you buying insurance? You're buying it because you might be wrong and you might crash. And that's my comment to people who are bearish on the market and don't want to buy RFIX. You might be wrong. And this is an extraordinarily inexpensive way to just get that shock insurance, that risk insurance that you might be wrong. I think rates are higher for longer. I'm not saying they're going to blow up to 8%, but I mean, could 10s go to 5? Yeah, why not? If the Fed not cut rates this year, sure, why not? But you know what? Mike might be right. We might already be in a recession. And then what's going to happen? It will be power windows down. That's why you buy RFIX as a hedge, because you might be wrong.
All right. We'll leave it there. Thanks everybody for listening today. If you want more information about RFIX or any of the Simplify ETFs, you can go out to info@simplify.us. Also, we're available to Harley or myself. Reach out to any of your sales contacts. We're happy to jump on any calls and do any more one-on-one engagement over RFIX. We're excited about the new product. And then just last final housekeeping, we have the next fund deep dive live is in our EM bond fund game, GAEM EAEM ticker, and that is in February 20th, 2025. So stay tuned. Thanks everybody again.